All right, let's get right into it. For years, we've all heard the buzz about blockchain changing the world, but now it's not just talk. The actual titans of finance, we're talking BlackRock, JP Morgan, Goldman Sachs, they are making their move. And look, they're not just dipping their toes in the water. They are building the fundamental infrastructure for a completely new kind of financial market, all centered around tokenizing real-world assets. This isn't some far-off prediction. It's a massive shift that's happening right now. And when I say massive, I mean staggering. A recent report from PwC and Nethermind is projecting that this market for tokenized assets could hit $16.1 trillion by 2030. Let that sink in. To put that into perspective for you, that's bigger than the entire current GDP of China. So yeah, this is not some niche crypto play. This is Wall Street's next trillion-dollar bet. So what exactly are they betting on? Well, it all boils down to this one core concept: real-world asset tokenization. It sounds complicated, but it's actually pretty simple. You're basically creating a digital version, a token, of a real-world thing on a blockchain. Think of it like a digital title deed for your house, or a digital certificate for a share of stock, or even for a government bond. And once that asset is a token, it can be traded, settled, and managed with the speed and efficiency of the internet, 24/7. It's a total game changer. And like I said, this isn't just a cool theory anymore. The biggest names in finance are rolling up their sleeves and actively building the platforms, the new financial rails to make all of this happen. They are not waiting around for someone else to do it, they're leading the charge. Let's take a look at what the heavy hitters are actually doing. So first up, you've got BlackRock, the biggest asset manager on the planet. Their BUIDL fund is already the world's largest tokenized government bond fund. Now, what's really interesting here is they launched it on a public blockchain, on Ethereum. But, and this is a big but, they've created what you might call permissioned DeFi. It's still decentralized finance, but with a catch. Only vetted, compliant investors can get in. This basically creates a blueprint for how to play by the rules while still using a public network. Then you have Goldman Sachs, and they're playing a totally different game. They've built their own platform called GSDApp, or Digital Asset Platform. This thing is a completely private, custom-built blockchain. It's designed specifically for their big institutional clients to issue and manage assets like digital bonds in a totally controlled private environment. And it's not a test. They've already used it for major bond issuances, proving that their model works. And of course, JP Morgan isn't sitting on the sidelines. Their Kinexus platform is already an absolute powerhouse. Get this, it's processing somewhere between $2 to $3 billion in tokenized asset transactions every single day. Most of that is in US Treasuries being used for things like overnight borrowing. This isn't a pilot program. This is a high-volume, real-world financial engine running on-chain right now. So what you're seeing here is a fundamental split, a fork in the road for the future of finance. You've got these giants all moving in the same direction, but on different paths. And that brings us to the big question: where is this new tokenized world actually going to be built? Is it going to be on open, public networks for everyone, or on private, permissioned ones for a select few? Let's just break down the difference, because it's really important. On one side, you have public blockchains like Ethereum. They're totally open, permissionless, anyone can join, everything is transparent, and it's decentralized. Then, on the other side, you have these permissioned networks, like JP Morgan's Canton. Here, access is restricted. You have to be approved to join. Transactions are private, and a small group of institutions stays in control. It's really that classic battle between an open ecosystem and a walled garden. And this quote, it just nails the institutional mindset behind these private networks. The thinking is that for these massive firms, things like privacy, control, and absolute compliance, they're just non-negotiable. So instead of trying to adapt to the open roads of the crypto world, they're just paving their own exclusive private highways built specifically for institutional traffic. But here's the thing. It doesn't really matter which path wins out in the end, public or private. Getting from the billions being processed today to the trillions everyone is talking about, well, that's way easier said than done. There are some huge real-world hurdles that the entire industry has to figure out how to clear first. We can really boil it all down to 4 key challenges. First, regulation. The rules are a mess. They're complex, different everywhere you look, and they're always changing. Second, standardization. We need a common language, so all these different tokens can actually talk to each other. Third, privacy. Big institutions simply cannot have their trading strategies broadcast for the whole world to see. And finally, the big one, the real monster under the bed, liquidity. Now, the good news is that technology is evolving to tackle some of these problems.
Take this diagram, for instance. It looks super complex, and honestly, you don't need to understand every single box and arrow here. The key takeaway is that this is a new kind of token standard that builds identity and compliance rules directly into the asset itself. Think of it like a smart token that can automatically check if a potential buyer is legally allowed to own it. It's like embedding the rulebook right into the code.
But even if you solve for compliance, you're left with this absolutely critical question, which was posed in a recent academic paper. It really gets to the heart of the whole matter. See, creating a token, that's turning out to be the easy part. The really hard part is creating a market where people can actually buy and sell that token easily. That, right there, is the liquidity problem. And the data on this is crystal clear. When you look at the secondary market, the place where these things are supposed to be traded, for most tokenized assets like private credit, stocks, or real estate, liquidity is just incredibly low. Just because you slap an asset onto a blockchain doesn't magically make it easy to sell. Outside of something super standard like gold, those deep, active markets for these tokens, they just don't exist yet. So where does that leave us? Well, you've got all the big players fully committed. You've got a clear technological path forward. But you've also got these significant, very real hurdles to get over. Navigating this path from the billions that are on-chain today to the trillions that are projected for tomorrow, that is the great challenge for the next decade of finance. So you might be asking, why are they so motivated to solve these huge problems? This chart really puts it all into perspective. Right now, tokenized funds are just a tiny sliver, a few $billions. The entire addressable market on-chain today is maybe $200 billion. But look at the prize. The expected growth in the fund industry alone is 30 times trillion dollars. If they can capture even a tiny fraction of that in a tokenized form, well, that's the ballgame. Okay, so what are the key analyst takeaways from all of this? Let's sum it up. 1. Tokenization is real, it's happening right now, and it's being led by the biggest names in finance. 2. The central conflict to watch is this battle between open public networks and private institutional platforms. 3. The key to unlocking all those trillions in value really hinges on solving for privacy and, most importantly, for liquidity. And 4. The future probably isn't one side winning. It's likely going to be a hybrid system that combines the strengths of both. Which really leaves us with one final and, I think, pretty provocative thought. For years, the promise of this technology was that it would democratize finance, giving everyone access to everything. But as we watch these institutions build their own private highways and walled gardens, are we actually getting a more open and fair system? Or are we just watching the same old finance rebuild itself on new, more efficient, but maybe just as exclusive digital rails? This is not financial advice.